Could the stock of Mondelez, the snack food giant, which has been in the 40s for the last 2 years, finally be ready to break out from this range? Even if you're not familiar with the company, you've all chowed down on their wares here. You've got Nabisco, Oreos, Cadbury, Philadelphia cream cheese, my fave, Chips Ahoy, Nilla wafers, Trident gum, Tang. There's so many other great ones. While its stock has been trading sideways, Mondelez has been working to rationalize its portfolio and come up with some terrific new growth strategies. And it's starting to work as costs have come down mightily. And the company's got some top-line growth that I think is being ignored since the last quarterly report, which was quite good. Oh, and there could be some consolidation in the industry that just might boost things further. Who knows? Just last week, Nestle announced that it's putting up its U.S. confectionery business for sale. Mondelez may be one of the obvious potential buyers. So is it finally time for this terrific food company stock to take off? Let's check in with Irene Rosenfeld. She's the chairman and CEO of Mondelez International. Learn more about how our company's doing, where it's headed. Ms. Rosenfeld, welcome to Mad Money. Great to see you, Irene. Have a seat. All right, you have really put it together. Over the last 5 years, you've cut costs out remarkably. The margins are about the best in the industry. You've got some top-line growth. Do you think are people going to start recognizing in your break out of the pack, which does not have that kind of growth or those margins?
I hope so. I mean, I think we've delivered about 500 basis point of margin expansion over the last couple of years. We've delivered double-digit EPS growth, returned $15 billion to our shareholders in the form of dividends and buybacks. So we've got a really strong story. The challenge has been our top-line growth has been a little more muted. Right. But as you said, it's still distinguished. We've distinguished ourselves relative to many of the peer companies.
Well, what's interesting is the emerging growth markets are fabulous for you. Can those grow even faster than they are now?
Absolutely. I mean, when we formed the company in 2012 and we split off from the North American grocery business, that was the thesis. About 40% of our revenue is from the emerging markets, and they were growing at healthy, high single-digit, double-digit rates.
And the split off, just so everybody knows, that you engineered has brought much better return than the S&P, and that's really important to point out. Yeah. Now, one of the things that people might say is, well, wait a second, it's snack foods. How much are people still eating snack foods? Are they good for you? Are they just treats? How are you dealing with the idea of the healthier consumer?
Well, look, we love snacks, and the reason is because it's a $1.2 trillion set of categories globally. It's growing everywhere. If you look at the demographics of the consumers around the world, you have more women in the workforce, you have people commuting longer distances to work, so they're not eating traditional meals, they're eating snacks. Right. And so we like the margins. The margins, this private label penetration is much lower in snacks than you would see in other food categories. So we feel really terrific about our portfolio, and we think it is poised to break out.
There's other things you're doing that I really like. You're doing some terrific social media, probably one of the most advanced companies in recognizing where the people are. Yeah. And how are you allocating your marketing dollars?
Well, we've got 14 million Facebook fans. We're in the top 5 food brands. Okay. And we have an incredibly loyal following. And in today's digital world, that's really important as we think about how do we continue to build the equity of the brand.
Dunk challenge kind of thing, right?
The dunk challenge kind of thing. People have served Oreos at their wedding. I mean, there's a whole site to give you different ideas of what you can do with Oreos at your wedding. So there's a lot of leverage in these brands, and we are taking every action we can to shift our spending from traditional media into digital. It's going to be about 30% of our spending by next year. In markets here, like here in the U.S., it's about 50%.
All right, have you won back Donald Trump? He said, I love Oreos. I'll never eat them again. Okay, I'll never eat them again. Yeah, and he says, because Nabisco closes the plant, just announced a couple of days ago in Chicago, moving plant to Mexico. Have you resolved that? Does he understand what was going on?
Well, look, in fairness, I think there was a lot of misstatement in some of those early statements. The fact of the matter is the United States is a major manufacturing and business hub for us. We've got 17,000 employees here in the U.S. We absolutely continue to manufacture all of our products here in the U.S. We just happen to have located 4 lines in Mexico, but we've invested over $500 million in our manufacturing facilities here in the U.S.
And you do something else that I think younger people now follow and make decisions about where to work and also where to eat. Sustainability development goals. Talk about your cocoa project, which I think is extraordinary.
Yeah, well, obviously, cocoa is a very important input ingredient for us. We're the largest chocolate manufacturer in the world, and we care a lot about the future of our supply. And so we have invested over $400 million in a program we call Cocoa Life. The intent is to help improve the livelihoods of cocoa-producing farmers. Many of these are family-owned businesses. Many of them are small leasehold farms owned by women. and the opportunity to help these farmers earn a more attractive livelihood, to learn how to use modern state-of-the-art farming methods. All of that is good for them, and it's good for us.
You're talking about tens of thousands of people.
Yes, it is.
Well, that's fantastic. Now, I wanted to ask you, you know that Nestle's put this up, and you can't necessarily say, yes, we're going to bid for it, but the Butterfingers, Baby Ruth, those seems like old brands, but I don't know. You've been able to revitalize some old brands. Is that worth kicking the tires on?
We look at everything that's out there,
right.
But I feel very comfortable with our portfolio as it exists today. We have a very robust set of growth strategies designed to take these iconic brands and bring them to the next level.
It seems very clear that you've got some power brands that are growing really well. Would it pay to just say maybe trim the ones that aren't and put more money toward power brands?
Look, we love our power brands. It's 70% of our revenue, and they're the brands that you know best. They typically have higher margins. They're growing at twice the rate of the rest of the portfolio. But the reality is the other brands, there's some very good brands in the rest of the bunch there. About a third of these non-power brands are brands like Nilla wafers, Nutter Butter that you know well, that have very good potential and very good growth potential. There's a portion of those brands like Cheese Nips, for example, here in the U.S. that just provide scale for us on our trucks and on the shelf. And then there are some that actually are candidates to be taken out. And slowly but surely, we just announced a deal for some of our French confectionery brands that we sold to Eurozeo. And we will continue to look at opportunities to do that, but we want to do it in a disciplined way, because I don't want to give up the shelf space, and we want to make sure that we don't open the door to competition.
Speaking of shelf space and competition, one of the things that you guys have been great on is online. So I know that already with Amazon. You've said that even in the June conference with your person who now runs the USA. But you have to think it's a stunner, this Whole Foods Amazon tie-up. Does that cause a kind of like a battle station meeting at Mondelez where what do we do?
No.
No. Okay. Okay.
I think if anything, it's a clear validation of the notion that the consumer is shopping everywhere, and all of us better pay attention to that.
Well, that's something you recognized early on. You do a huge snack business on Amazon already.
Yes, we do. And snacks as a set of categories are not yet that big. It's only about 2 to 3% of sales here in the U.S. But over time, we intend to be the snacking leader online as we are in the bricks and mortar space.
I was just going to ask you about brick, but the other brick, other than Brazil, it seems like that you're really getting some great traction. Russia's coming back, green shoots.
Yeah.
China, Germany's remarkable. I mean, it really seems like as economies come back, they snack more.
Absolutely. And that's why we have such great confidence that this portfolio is poised to break out on the top line as it has on the bottom line.
You've always said that there has to be more consolidation in the industry. Is it imminent, or is it everybody left doesn't want to be taken over and wants to stay independent?
Every time there's an announcement of any transaction, everybody says, oh, that's the beginning of a big wave of consolidation. I think each company has to think about that for themselves. Again, I come back to our company. We have a fabulous portfolio. We have a fabulous geographic footprint. 40% of our sales are in the emerging markets. They are coming back. They will come back even more. And we feel terrific about the supply chain investments.
Okay, one last question. I know that U.S., you were not happy. You said that in the last quarter, but you've made some changes. I look at this. I think that this is brilliant. I think the Oreo candy bar is fantastic. You're doing a lot of fun stuff with Oreos. Are we going to see a turn in the U.S. this year from the changes you're making right now?
Yes, you will, Jim. And I particularly think in the back half of the year, as I said in the earnings call, we have the most robust health and well-being pipeline in our U.S. franchise that we've ever had. We actually have a number of products that are just renovations of existing things like Belvita protein with 10 grams of protein. Very, very strong item for us. We actually introduced a product called Good Thins last year that's selling quite well. It's going to be about over $100 million this year for us. We have a GMO-free version of Triscuit coming out. So we're doing lots of work in terms of renovating our core portfolio. Ritz Crisp and Thins, which is a fabulous chip-like product that's oven-baked, not fried, 50% fewer calories than regular chips. But probably our most exciting item is this one called Véa. And it's a whole new product that we're launching in July. And the combination of all of these items, together with very strong execution, is what gives me great confidence in the back half of the year.
Well, it gives me great confidence this is the right level to buy the stock. It really is. And whether there's consolidation or not, it's going to work for you. That's Irene Rosenfeld, the chairman and CEO of Mondelez International, taking out a huge amount of costs and now going on offense with a growth strategy. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.